Good morning. Well, the Federal Reserve met yesterday and the day before, and they announced that they wanted to reduce rates by 50 basis points, which is a big move. And usually it's a move that is ahead of a recession. But so far, the first report after that rate cut was the employment report. And that report was actually looking pretty good. It wasn't looking all that concerning. If you look at the initial jobless claims, they came in at 219,000 when 230 were expected. And if you look at the continuing jobless rate, it actually came down a little bit. So both of those measures show that the economy is either destined to have no landing or a soft landing where we have a very light recession. That's really good news. So it's a little bit of a paradox, just a slight one, that the Fed would move 50 basis points. And but the market really likes the whole situation. The NASDAQ is up 2.12% in pre-market trading. The S&P is up 1.55% in pre-market trading, and then the Dow is up 1.11%. Now, it's one thing for it to open nice and high, but let's see if it sustains those rates or that appreciation level up until the close. Oil prices are up. Looks good. Let's take a peek at crypto. Crypto BTC is up almost 2%. It's nearing 63,000. Bitcoin was really shaky for the last month or so. It got down to $54,000 per coin, and now it's up 16.86% just in the month of September. Beautiful. I own crypto. It's the smallest asset class in my overall portfolio, but I own it. And I've been buying into it since 2018 and believe this space is a good stored value space for me. And it's good to see BTC rally. With regards to, it looks like I like looking at Asian markets because they are either closing or have already closed. In Japan, their stock market closed 2% higher, and that market's been doing really well. So that looks good. I believe the Hong Kong exchange closed 2% higher. I mean, that's really good. So I think this rally is looking pretty darn good, man. I was expecting that we were going to get through the Fed meeting combined with the employment report, and I was feeling a little pessimistic and feeling that, hey, stock prices were a little expensive going into both of those events. I still think the stock market's expensive, but the two reports combined is actually pretty positive news. It is interesting that the Fed went a full 50 basis points, given that unemployment's fine. Given that the economy, I don't think is sputtering. You know, you could point to a couple of industries and say, well, they're a little slow. Can you lower interest rates? I do think that the lowering of interest rates does help, people that are looking to buy a car. I think their interest rate is going to be lower, maybe save them, some dollars each month so they have a little more discretionary income. Most definitely home purchases, as you apply for a loan and buy a house, that interest rate is going to be lower. And across the board, big discretionary purchases, credit card revolving debt is going to be a little bit lower. So all those things put together will help the consumer. And, the Fed has a lot of data to work with. So that's what they decided to do. So that's the big news is the Fed rate cut. We got through the employment data. That's the big report that I look at. Later on, we're going to see existing home sales. That's interesting, but it's really a very narrow part of the overall market. It doesn't really affect stocks, in my opinion. One thing I like to look at is the bond market. So the bond market is actually rates are increasing. So you can see rates are increasing, and this is a pretty good move. And you see on the short end, they're not moving as quickly. And if you recall, we were inverted, meaning the 2-year for a while was higher than the 10-year. But we're back to what is considered normal, which is the 10-year is paid at a higher yield than the 2-year. But these rates being up here, I bought bonds yesterday, and I was fortunate to buy early in the day, and then because the market really rose, if you recall yesterday, and it really drove rates up, which means a bond price goes down. It's a better time to buy. And I bought early in the day, and then the market really faded and pretty much closed in the red. And then rates went down and bond prices went up. So in that one day, I mean, it was a $2,000 purchase, but I probably gained, I don't know, $10, $20 of a gain, but it's a gain. And today, I'm probably going to buy another $2,000 of bonds. I like buying bonds when, things are pretty good in the bond market, and I just buy them over time. And I continue to replenish my bond ladder, which covers my living expenses for the next 5 years. I continue to do that. Just buy it when the buying is good. You're not forced into it, and you really benefit from a higher rate. In this case here, I think rates most definitely are going to continue to go down over time. If you look at where we're going to be a year from now, the Fed, their target is to be a full 100 basis points, a full 1% lower in 1 year. And then probably in 2 years will be 150 basis points lower. That's a big move for bonds. So it's good to lock those rates in now. So I'll be doing that a little later. All right, so that's what's going on in the market. We'll watch the market open in about 23 minutes. In the meantime, let's take a look at some stocks. There's 2 stocks that I wanted to talk about. And one is symbol GCT, and the other one is symbol ZIM. I sold ZIM, and I'll go through my whole thought process there with you and share with you what my exit strategy was on that stock and go through that. If you guys want to look at a stock, please let me know in the comments. We'll take a look at it. If you want to talk about something, put it in the chat. We'll talk about it. Let's get into this. All right, let's get the juices flowing with one stock that was actually suggested by a user, a viewer, and that's GigaCloud. And I'm going to go through a full analysis of GigaCloud. It's a stock. It's kind of funny. I've had it on my to-do list for about a week, and I still have some of the analysis open. And I thought, okay, I got to get to this. And why don't I just do it in the live stream and kind of do it with you, and we can kind of go through this together. So GigaCloud is a company that does all the logistics, the delivery. When people buy like a big item online, so they buy all this furniture online, they love it, they click buy and deliver it to me. Well, UPS, FedEx, even Amazon, they have a hard time delivering big items like this. So GigaCloud's really specializing in that big item to consumer delivery service, which is a growing category. So they've become good at it. And overall, I like that the company has a specific focus where they've become a trusted brand for all these e-commerce retailers. And that's good. They've made themselves unique. They've separated themselves from the market. They've made themselves valuable. Is it a sustainable moat or economic differentiator? Not for a super long time. I don't think there's really strong barriers of entry into their market where, I think other companies can start, or maybe UPS says, hey, we want to be a part of this and we already have a network. So we'd like to compete against these guys. All those things could happen, But I think temporarily they have an advantage, and they probably have a very good brand with these e-commerce sites who need somebody that's dependable to deliver the products they're selling. So I get the company. I like the company. I would say that they are a desirable company, but not a company that's going to have these really strong, powerful moats and competitive barriers to keep competitors out. Just being realistic. But their financials look really good. When we look at their revenue growth, really good growth, 3%. I'm looking at their earnings. They have very strong growth, and they are profitable, and they generate cash, and they're accumulating cash. So that combination is really, really good in a small business. This is a tiny cap company. In fact, let's take a look at the market cap for this company. So GigaCloud is a $717 million company. So it's totally avoiding the radar. And one thing I wanted to show, I think they're being, I'm going to say attack is a strong word, but short sellers are all over it. So shares outstanding, 14%. So the short sellers are all over this company saying, oh, these guys are a gimmick. I don't trust them. I don't like them. And they're shorting it. Now, I short stocks as well, so I'm not going to be a hypocrite and say, oh, man, shorts are the most terrible people. I would say that I've never shorted a company that's struggling. It's not my style. I usually try to go after companies that I truly feel are really overpriced. And I usually go after companies that everybody loves and loves them too much, and I short them. We'll see how that works out for me. Today's going to be an up day of 2% on the NASDAQ. I think all my short positions are going to struggle. But in this case here, this is a small business. Not my style to kind of root against a small business. I actually am rooting for a GigaCloud. Hey, man, I hope they're 10 times bigger in 5 years. Excuse me while I enjoy my coffee. It is 6:12 a.m. in California. So if you wouldn't mind, I'm going to enjoy a cup of coffee with you. All right. So we know that this stock is being shorted. There's a little bit of concern out there, but I think it's shorts probably trying to take advantage of a small business, potentially. Their PE is really low. Look at that, 6. Wow, that's really good. Analysts, and we'll see how many cover it, they say it's a strong buy and it's highly discounted. Interesting. We look at the 5-year, they really had a nice run coming out of 23. Woohoo! And the stocks really come down in the last 12 months. So that's interesting. Okay. And then there's some articles of how the stocks declined, and the shorts are really attacking this stock. So that's interesting. This might be a good stock to talk to with Trader Prad and get his opinion on how. I love how he traps shorts and he talks about that. It's a technique that is pretty interesting to understand, and it'd be interesting to watch it play out. But I'm going to probably ask him about how the shorts are behaving in this particular stock. Looking further at this company, their revenue, again, a lot of green on the screen. And you think about it, it kind of makes sense, right? The economy is moving online. If you look at purchases, like my wife and I, right? We bought this gazebo for our backyard. And this gazebo's, geez, it's 12 feet tall. It came unassembled, but it came in this box, and the box weighed, geez, 150 pounds. So I got it to the backyard. I assembled it, got it all upright and so forth. That's exactly the kind of product that these guys are delivering. And if you look at the growth in that area, it's, the economy is not set up for these retailers to have these big stores where they have big products like a gazebo on display. It's just too expensive. And e-commerce, we've become really comfortable buying online, whether it's a refrigerator, a gazebo, a big item. we've also bought for our backyard. We bought these umbrellas, to give us shade. And these umbrellas are pretty good size. Again, bought them online, bought a brand that we're familiar with, got them delivered. So the economy as a addressable market is expanding. So GigaCloud can continue to grow. First, they're small. Second, they're in a space that's expanding. And if their brand and they're a trusted partner to a lot of these e-commerce companies, I think they can continue to grow. So I like their space. I like that the company's growing. Let's look a little further. Let's make sure the balance sheet doesn't have a ton of debt and is setting us up for a big problem. So they have $207 million of cash. And total debt, they have $517 million. So net about $300 million in debt. If we look at their EBITDA, which is $140 million. So 300 million divided by 140 million is a little more than 2, which they could pay off their debt and they focus their earnings before income, interest, taxes, and depreciation. Then they could pay it off in a little over 2 years, which is acceptable. I look for a 3 or less. So that way the company could take care of their debts. So that looks good. So balance sheet looks good. And now let's take a look at the cash. See what kind of cash flow they're generating. And their cash is $114 million in the trailing 12 months. Now, this is a growth business. If I took that times 20, I'd get to a valuation of about $2.2 to $2.4 billion in market cap, but they're only $717 million. This has a lot of value to it. If this business is legit and they continue to grow, this is a really good opportunity. So let me go ahead and get into a full model for these guys. I'm going to move this spreadsheet over to another screen, and then we'll take a look at the model that I put together for companies. I don't think I have GCT in my, excuse me. I don't think I have them in my model yet. Oh, I do. Cool. All right. We're off to the races. See, I started on the 11th. I started looking at it and things come up, man. I'm busy. I'm busy trading, investing, talking to you guys, doing all kinds of good stuff. So I've already I think what I took was the last 2 quarters, annualized it, and then I took the growth rate against it and got to 110 million. So the forecast is, I expect they're in an expanding market of people buying stuff online. They're doing a good job. They're growing their revenue. They're located in Los Angeles, which is, Los Angeles is strategically located where we have 2 major ports that import goods from China primarily, and then a lot of distribution happens to the country. If you go inland a little bit from Los Angeles, we have these massive warehouses. The biggest warehouse in the United States of America is actually being run by Target, and it's in a city by the name of Paris, California. This warehouse, I've driven past it. This past summer, my son, he's 20, he did an internship at Amazon, which is a warehouse right next to Target. This warehouse is massive. It's like at least 8 football fields put together. It's massive. It's like its own like zip code. And that type of volume goes through Los Angeles. And I bring that up because this company is strategically located in one of the logistics hubs to the country. And that's a very good place to be. They're in an area of Los Angeles that isn't too high with regards to lease rates for warehouse space. So I like where they're located. All right, so we're going to try to fill in, make sure everything looks good. Cash looks good. Now, debt, I need to update because we did have some debt. And, I'm going to take a look at their actual financials. Let's see here. So we went over cash, restricted cash. So this is when you look at cash, and then the investments, right? Because this could be bonds. It could be things that they could sell and liquidate quite easily. Then we look at debt. So accounts payable is not debt. Lease liabilities is not debt in my book. So they really don't have any debt. You see how I think websites are terrific, like stock analysis. But it's always wise to go to the financials because that's the horse's mouth. That is the true, financials. The websites that aggregate information, they try to put everything into standardized buckets of information, and sometimes they get it wrong. In this case, it's wrong. They're listing that the company has debt when actually they don't. So that's an important factor, right? For two reasons. One, qualitatively, it's a stronger company. If you don't have any debt, it goes to show you're operating really well. Second, from a quantitative perspective, we don't have to add debt to my model. All right, so the equity value of the company is $2.4 billion. Holy smokes, that's a pretty good valuation for a company that only has a market cap of $717 million, soon to be quite a bit more because it's going to go up 3.75 in today's trading. But I'm going to look at the data that's available to me. I'm 9 minutes from the market opening. So this is a really discounted company. I am interested, and I'm located so close to this company, and I actually go visit my mom every weekend. She's 88 years old. She lives in Los Angeles, and I drive near this area. So I'm going to do a drive-by and maybe even try to do it on a weekday when I can stop by and visit, maybe talk to the company, see what their operation's all about, see if I can glean anything from that visit. I think it'd be smart. And if I can establish a relationship with them, heck, I might become a substantial investor. We'll see. All right. So we went over the cash flows really show a very valuable company. Now let's take a look at their forecast, which is going to be three analysts cover the company, right? So on stock analysis, and let me show this screen because I think it's interesting. So three analysts cover the stock, and the most pessimistic analyst says it's underpriced, right? It really is worth $35 a share, but it's going to sell at 18. The average is 51, and one analyst says it's worth $70 a share. So everybody's saying this company's worth something. And when we look at their earnings per share, it's positive, man, and it's growing really well. Holy smokes. This is a good opportunity for me. Let's keep looking, man. I like what I'm seeing. And this came in as a suggestion by a viewer. So, please keep suggesting companies that you come across that you think, wow, this is an interesting company. So the earnings per share is $2.93. I'm going to go with a PE of 12, grow by 15. I get a per share value based on earnings per share, $40. And the stock's trading at 17, so big discount there. So holy smokes, we got a company that's discounted by 205%. The stock can triple in value. Isn't that great? So I'm going to put these guys most definitely on my watch list and really track these guys and just keep an eye on them. I think we're obviously in a rally. We're in an expensive market. So I'd like things to settle down. And it gives me a little bit of time to go visit these guys and see what they're all about. Maybe I'll take a few pictures and I'll share them with the community. So that's GigaCloud. I thought they were a pretty good little company, and I wanted to share that with the community. So let me see if there's any comments out there, see what's going on. And I'm still not getting any comments. Hopefully you guys can hear me okay. Let me check my Discord, make sure the radio waves are working. Yeah, looks good. So that was GigaCloud. Now the next one I'm going to cover is Zim. And Zim is a stock that I've been tracking for a little while. If you look at Zim as a company, it's had such a roller coaster stock price ride. If you look at the 5-year, you go back and you study that we had supply chain issues, and that drove up the shipping rates for the shipping companies that move cargo from like China to LA, China to Europe, Europe to, all these different ports. The race went like triple, which means Zim was making a lot of money in this era. So if you were fortunate to own Zim at the beginning of the run, in the matter of about a year, your stock was worth, 600% higher. Wow, incredible. Now, rates were not going to stay at that level forever, and they began to really come down. They really did come down a lot, like 75%. And the market said, well, these guys are just going to be worthless. We're going to sell them off by 92%. And I kind of laugh because I'm like, sometimes the stock market is so irrational. Sometimes irrational as the market goes up, and sometimes irrational as it goes down. In this case here, how could you rationalize that this company is only worth 8 cents on the dollar? But the market did that. But it really presented a nice opportunity because I studied shipping rates enough to know that, hey, historically, they're higher than where they were, call it a year ago. And I expected if there was just any modest increase in shipping rates, these guys would flourish. And looking at their cost structure, one thing that Zim did do during the go-go years when they had lots of cash is they bought new ships. They became more efficient. New ships for a shipping company, they spend less fuel. They're more reliable. They're in service. They can, really make more money when they operate those new vessels. So I thought that was a positive. So I started buying into a position and ended up selling that full position yesterday. And I took a nice gain. My stock was worth about $27,000, and I had a 50% gain on my investment. So I made a little over $8,000 in the course of 8 months. So if you annualize a 50% return, 8 months, you're looking at like 80% return on that investment. Very happy with it. Now, why did I exit the stock? I had put a $30 target to sell. And the reality is that I begin to see headwinds coming up. I think the economy is going to slow down a bit. It could be, there is some risk because I'm in the US, Zim is located in Israel. And it actually was interesting to own a company in Israel. But a lot of things could happen that could take this stock down. And I think it's trading at around $20 a share. That's a pretty good share price for this company. I'd like to sit out the next couple of quarters and see where the economy's at, maybe in 2 quarters, and maybe decide to get back into Zim. There's nothing against, taking a gain and then watching the stock operate, then eventually getting back into the stock. So I exited the stock. It created more cash. It's good to have a little more cash these days as we see the market operate. And that's Zim for you. Just looking at the valuation of Zim. So here is Zim here, and the valuation, it's a discounted company, really nicely discounted. And I made 8,800 on a nice investment in the company. And I think I'm in the way there. Let me get myself out of the way. So, nice gain on, a modest investment of 17,000. And I really accumulated that position quickly because I knew that, hey, this company is discounted. Shipping rates are really improving. And that's where this company also was being shorted. And the shorts really had it right for a while, right? If you look at the short sellers had it right as it went down. But at a certain point, it got way below its intrinsic value. And I'm glad to take advantage of it. So that was a good company, good stock. I'm part of a Reddit subreddit. And the folks there on Zim, man, I let them know that, man, I hope they make a ton of money. Great group of investors there where we're kind of sharing information to one another. And I will continue to follow that subreddit, but I need to manage my portfolio. One thing that I wanted to do is I want to tighten up the number of companies that I have. I have a pretty good number of companies, and I really like a lot of these companies, but I'd like to tighten the list, get to a smaller a number of companies that I'm invested in, so I can do deeper analysis into each one. And that's one of the efforts. Zim ended up being the odd company out, and I removed him from the portfolio. And who knows, maybe I'll get into GCT, and that'll be my industrial logistics stock going forward. We'll see. Or I might get back into Zim. We'll see. All right. Looks like the chat has really caught energy and the stock market has opened. Let me look at the stock market just really quick, guys, because I got to see this. I got to enjoy this. I got to soak it in. It's like sitting down at a nice dinner and you're about to take a bite of the beautiful meal that was put in front of you. Look at that. Look at that. 2.3% on the NASDAQ, 1.6 on the S&P. And I've got my portfolio open on another screen here. Let me see if I can take a peek, because I like looking at overall how much my portfolio went up. That's always a nice snapshot to take. Yeah. Okay. All right. We're up $27,000. Wonderful. All right. It's been a good day. I can call it a day. I could take the rest of the day off. All right. So market's doing great. Let me catch up on comments. Mike, the dividend investor guy. Sorry you're late. No worries, Mike. Good to have you. You always bring a lot of good comments. So thanks for joining. Ron Kim. How are you, sir? Thanks for joining. And Mike, I sold my Zim again. All right. So I think you and I are on the same page there. I think it could get to $30 a share. I made a portfolio decision, and I think it's Nichix. I hope it gets to $40 a share for you. I really do. I'm rooting for Zim, and I'm rooting for all Zim stockholders. Just because I sold my shares doesn't mean I'm not going to root for the company. And I hope it gets there. I hope it gets there, man. Retired guy, CFG stock. Let's take a look at it. CFG stock. Let me catch up on some others. What are you thinking on SBLK, HAFN, since you got out of Zim? So one thing I would say, so I'm going to look at them. SBLK and HAFN. Okay. So Zim was always a stock that I was going to be in for maybe a year, maybe two. It wasn't like, hey, I'm going to own Zim, and 10 years from now, it's going to be worth a lot more money, or 5 years from now, it's going to be worth twice as much. Shipping is not exactly cyclical. It's different. When the shipping industry has boom periods, a lot of ships get built and get put into service. And that additional supply of ships causes rates to come down. And they stay down for a long time because everybody put too many ships into service. Then they start retiring some ships because they deem to be unprofitable. They burn too much fuel. they break down too much, they have too much maintenance cost, so they retire them. Then the number of vessels in service goes down, supply goes down, and shipping rates go up. I'm expecting that at some point the industry is going to hit that kind of equilibrium is going to be broken, and then the shipping rates will benefit the customer, the companies that are actually doing the shipping. So keep that in mind that, hey, shipping companies, it was the right move to kind of take advantage of a market that was just, unreasonable in discounting Zim and probably other companies. But the conditions are not meant to last. The conditions, you have to be aware that, hey, this industry will have a pretty bad recession where there's just too much demand or too much supply being provided in the market. So keep that in mind. We'll take a look at those companies. All right, let me enjoy a little more coffee. It is still only 6:36 in the morning here, so excuse me. Trader Prad, how are you, sir? Enjoyed your live stream yesterday. Everybody, Trader Prad streams the evening before a trading day, and he streams at 8 p.m. Eastern. And I would say that I get a lot of value hearing somebody talk about companies, because there's a lot of sentiment covered in his stream about, conditions in a company and so forth. And he covered some of the stocks that I own or track, and I get a lot of value from looking at a different point of view on a company. So I encourage you, attend Trader Prad's stream. I think you'll get a lot of value out of it. I'm attending. I attended 2 nights in a row, and I plan to attend tonight and continue to listen in and see what he's seeing or hear what he's seeing. Try to use that as an additional information stream from somebody who's putting his own capital on the line, making decisions to make money. So really appreciate you, Trader Prad. And I, again, encourage you to take a look at his stream. And of course, subscribe to his channel. Mike, the dividend investor guy, agree. I wanted to tighten up my investments to 20 to 25 for a while. I'm still around 50, which is way too much. Yeah, it's so one of the legendary super investors that he was my favorite for a long time. Now it's Pat Dorsey, but before Pat Dorsey, it was Peter Lynch. And Peter Lynch just kicked butt and took names in the 80s, going into the 90s. He had the Magellan Fund. And, you can look up Peter Lynch. And the long and the short of it is, he was the dominant fund manager of his time. His Magellan Fund became the biggest because it was the most successful. He outperformed the S&P. He outperformed everybody. And a couple of things that he was different in. First, Peter Lynch was more qualitative. Okay. He didn't just look at numbers and say, oh, look, this company, they have these ratios and I'm going to buy. No, he liked to understand, is that business is an expanding market? Really understand the kind of like the environment and the facts surrounding the company. He was not a finance guy, which is super interesting. He worked at Fidelity, but he was not a finance guy. He wasn't a fund manager to begin with, but he looked and said, hey, I think I could do that. He became an analyst, then became a manager of his own fund. So he really did not abandon what he felt was his strength, which was to understand companies and understand industries, situations, and kind of the dynamics that are not easily put into numbers, and take advantage of that. And he was excellent. The other thing that he was criticized or was different, and I say criticized because he was criticized at the beginning, is he had a high number of stocks in his portfolio. He liked having his risk spread out, and he really so it was almost like betting on a lot of small cap stocks and seeing which ones were really performing and doing better, and then adding more to those positions. And he couldn't get there unless he really put himself out there and started investing in a broad basket of stocks. And at the beginning, the more established traders or investors, I should say, at Fidelity criticized him and said, "You're out of your mind. Why would you be doing that? You're a knucklehead for doing that." And he stuck to his philosophy, and he crushed it. He crushed it for like 10 years. Peter Lynch. And I love his story. I love how he was an outsider. It's One Up on Wall Street is a awesome book. I encourage you to read it. I think if anything, you'll get good philosophy lessons, good approach lessons. His era didn't have as much tech. His era was different. Pat Dorsey is a more, I would call him a more, a more current time investor that really invests in technology. And I love Pat Dorsey, and he does have a tighter portfolio. I really like what Pat Dorsey has to share, but I love Peter Lynch, and he was my first, Michael Jordan. He was my favorite for a super long time. So back to you, Mike, that, you're not breaking any rules by having a high number of shares or a high number of stock symbols. I have a pretty high number because I really enjoy it. But it is good to have a little discipline around, if I'm going to own a stock, I have to commit to evaluating that stock, keeping track of it. If I can't keep up with it, I got to lower the list. It's okay to have a high number of stocks, but I have to keep up with them. I have to track the companies, have to know what's going on with them. So that's my comment there. And, all right, so moving on. Trader Prad. No vacay. If the short is wrong, get the F long. All right. I just got to do Affirm and Tesla long. All right. So let's take a look at those and we'll see what's going on. I do have Tesla in my model. I can take a look at that. And Nichix, can you take a look at SLB? Absolutely. SLB. Let's go Tesla. What a long. All right. So let's take a look at Tesla. 1 second. My light here is freaking out on me. All right. Okay. Any update on Ford? I do have an update on Ford, and I will share that with you. And maybe after I get through these stocks. All right. So taking a quick glance at the market, we are still super green, super green. This is incredible Hulk day. Somebody has upset the market. It has gone through its mutation. It is angry to the upside, and it's a beautiful thing to see. It's like when the Incredible Hulk goes berserk, he's going to fight for good. He's going to be fighting for higher stock prices, and that's what's going on here. Look at all this green. Holy smokes. Is it St. Patrick's Day? It should be. It would be a perfect day for St. Patrick's Day. All right. Bitcoin is up. Wonderful. All right. VIX is down. All right. Party on Wall Street. Trader Prad. Baba and PD. Let's go across the Pacific Ocean to China and take a look at Baba and PD. All right. We're going to need to move a little fast. Let's do it. Let's get into some of these stocks. So we're going to start off with CFG, Citizens Financial Group. So Citizens Financial Group operates bank holding company that provides retail and commercial banking. This is a mid-sized bank. So there's the big, massive banks, JP Morgan, Bank of America, Wells Fargo, big, big, big. Citibank's, probably the smallest big bank. Then you have mid banks. Citizen, I think, is a mid bank, not too big, but not tiny. They have an $18 billion market cap. I like the banking industry, especially after today, where you see the economy isn't going to hit a wall. It's probably just going to kind of land smoothly, maybe have a couple quarters of lower than desired growth rate and so forth. Now, their revenue is $7 billion. When I value banks, I don't use free cash flows. It's not the appropriate way to measure. I want to look at book value and growth in book value, which represents value in that stock. We're going to look at that. We're also going to look at earnings per share. The way I look at earnings per share is fine, for a bank. Their PE is nice and low at 15. Today's day and time, the average P is like 25, which is kind of nuts, but whatever. All right. So looking at their dividend, nice dividend at 4%. Not bad. Not bad, Dad. And analysts say, hey, it's fairly priced. It is fairly priced. All right. Now, one backdrop to the finance industry is, so a couple of years ago, we had the Silicon Valley Bank run on their bank, if you guys recall. And that was actually caused by the Federal Reserve moving rates up really fast. When you move interest rates up, the value of bonds goes down, especially long-term bonds. And Silicon Valley Bank had a lot of long bonds on their balance sheet. So when they lost value, they had to restate those bonds. And when they restated those bonds and said, hey, we're going to lose money on those bonds, they've lost value, investors freaked out. And more importantly, companies, because Silicon Valley Bank was mainly a commercial bank, companies freaked out and pulled all their cash out of the bank. They had a run on the bank. Well, that freaked out the whole industry. Oh my God, banks are going to go bust. So in the 2023 era, you saw banks that were completely healthy get reduced in value. So I took advantage of it. I bought US Bank and I bought Citibank. And I made good money on US Bank, sold it, and I still own Citibank. So this is a condition within this industry that was a good opportunity. And if you look at after the big sell-off in 2023 in banking, these guys have been rocking and rolling up 80%, baby. Nice. And that is a good reward to investors who do their homework, who say, the market's nuts. Banking's fine. And banking, let us not forget, balances are guaranteed by the government unto a certain level. And the government doesn't like to see banks go bust. They like to rescue them because when banks go down, people freak out. So politicians are like, no, we can't let banks go bust because then, the population is going to get all angry and they're not going to reelect me. So that's what's been going on with the stock. So that's kind of like the backdrop of this stock. Is there more room to go to the upside? Well, historically, it was a stock that was trading up at $50 per share. So the answer is absolutely, it could still go up. When we look at the revenue has been contracting. And now the way a bank makes revenue is net interest margin. They lend out money and they pay out interest to their account holders. Well, when they're lending out money at lower rates, they don't make as much revenue. And I think that's what they're seeing in the trailing 12 months. Now, are they profitable? The revenue is going down. Net income, they are profitable. Not as profitable. I think the change in interest rates is really affecting them. All right. So they are going down. Interest rates are expected to go down further. So that's going to be, this reduction in revenue is probably going to continue because the interest rate graph is going to look downward for the next 2 years. So that's one thing to consider when you look at banking. When we look at their book value, I think I have it here on my balance sheet view. So book value per share, it's been kind of staying steady at around $48. I don't like that. I like seeing it going up. So I don't like that about that measure. I like it seeing going up. And if I recall, let me take a peek at US Bank or Citi Group and see how they measure. And the reason I use US Bank as an example is US Bank's similar to Citizens. They're kind of like the same size. And when we look at US Bank, they too are dealing with this lower interest rate. You can see that they're really growing nicely. And when we look at their balance sheet, book value. So they were at $29, $31, $32. They also kind of held steady. So you can't say that one is dramatically better than the other. So book value's been steady. And let's take a look at what analysts think and what their earnings per share, value is. They believe the stock's fairly priced. Okay. And basically that earnings per share is $3.15. It's going to grow nicely, real nicely. So that's looking good. But I think that the stock is fairly priced. I agree with the analyst on this one. And, right now I am holding my Citi Group shares. I own Citi Group, and that's my only bank. I sold some puts, and they're going to expire tomorrow, and they'll expire out of the money. So I'll just make the premium, which is nice. And I don't have a whole lot of Citi Group. I've invested $17,000. My stock's worth about $21,000. I've got a rate of return at 23%, and I collect a nice dividend of 3%. So collectively, it's about a 26% return. Very nice. I just think banks are okay, but I'd rather be in Robinhood, Coinbase, PayPal. Those are the stocks that I'm also in. I'm buying, I believe I was buying into Allstate, but Allstate's doing way better. It has a better performance for me. Coinbase is killing it. Robinhood is killing it. So when I look at financial services, there's an alternative to banks that I'd prefer, which is the companies I just listed out. Citi is one of the stocks that, I could see myself selling it. I don't want to sell it right now because I don't want to pay more taxes. I already had a tax problem last year, and I just sent in a tax payment on Monday for the US. You send in your estimated taxes. So if I sold Citi, it'd probably be in January, February. That way I deal with the taxes in 2025. So that's a quick review of Citizens. Good luck with it. I'm not eager to buy more banking stocks. I think there's other alternatives that look better within the financial services space. And good luck. Good luck. All right. So we went over Citizens. I think we wanted to look at SBLK. Yeah, these guys are a lot like Zim, if I recall. Yeah. Yep. These guys, according to analysts, they're discounted. When we look at their 5-year, not as bad as Zim. You see how they really ran up, and then they did not go down as much as Zim. Interesting. Okay. The 1 year, they've also been sold off recently. Their graphs are far more like stable, like they have a trajectory either on the upside or downside. So that's interesting. They have a market cap of 2.5 billion. With regards to shipping, look at this dividend. Wow. Awesome. I mean, I think I kind of shared everything that I had to share with regards to Zim. I think shipping is it's probably still going to be good. I don't know, for 2 quarters, but just don't be surprised if all of a sudden the bottom falls out of this industry. It is a industry that has a couple boom years and then a couple of really bad years, and a couple boom years, a couple bad years. When the bad years are going to start, you got to track that, because you could see this stock really drop 50% in a matter of 6 months. So that's what I would say. I think right now, this thing you can definitely prove out a discount. So if it's the right investment for you, it's the right investment for you. If it's something that you want to, I'm being cautious with it, but that's my decision. I don't ever recommend you buy, hold, or sell any stock. I just give my opinion. Hopefully you find it interesting. So that's where I'm at with the shipping companies at this time. And, it's good to know different industries. And I don't know that I've seen this one here. Hafnia. So these guys do oil product tankers. This one may be beginning to really work because oil prices are beginning to tick up. They're almost a $4 billion market cap company. Look at this PE, 5. Oh man, make believe. Strong buy at 28%. Looks good. Looks good. And I think that oil tankers, they have a different profile than what I would say like a Zim has. And these guys, what's the story here? I'm not seeing a very good graph. That's been pretty solid there. I guess they just started trading a couple of years ago. That's pretty solid. Yeah, pretty solid company. I should say a very good trajectory on their stock price. Nice upward and to the right. Their financials, they've been growing, consistent growth rate. The oil transportation of oil is not like moving of containers with product in them from China to other markets. These guys have specific vessels that safely transport oil and energy products from one part of the world to the other. And it looks like they're able to sustain the revenues far better. So this is a good idea. I'm going to take a closer look at this one. This is a really good idea to take a look at. This one would be one that I might want to start tracking and maybe get back into. So that's a good idea. Thanks for suggesting it. I think you can prove a discount on this one. When is the right time to buy it? That would be my next decision. The 1 year looks good. It's not a bad time to buy it. Holy smokes. Let me have another drink of coffee because I believe I'm seeing a 21% discount. Let me make sure I'm wide awake. 21% dividend. Holy smokes. Now, that's both impressive and concerning in the same breath because they shouldn't be paying such a high dividend rate. Do they have excess profits? Is that what happened? That might be it. And they're like, hey, we don't know what to do with this cash, so we're just going to dividend it out. Okay, that might make sense, but I'd have to look into that. Impressive. 21%. Holy smokes. All right, let's look at Affirm because Affirm is becoming really interesting, and here's why. Last week, I talked about some reports coming out that the consumer is beginning to accumulate too much debt, that they're beginning to default on auto loans and credit cards. And I thought about, okay, these new companies like Affirm, that is the whole buy now, pay later model where they're saying, hey, we've figured out a better way of, lending on big discretionary purchases. Like, hey, somebody buys a $5,000 product and they're like, hey, I don't want to pay for it all at once. And I don't want to put it on my credit card because that's a high interest rate. So what Affirm does is they partner with companies and they say, hey, well, we will allow the consumer to buy and it'll kind of be baked into the price. Okay, perfect. Now they're kind of behind the curtain. Affirm is basically taking that debt, and what they typically do is they sell it off to some investor who says, hey, I'll take on all that debt, but I'm going to take it on at a discount. You give me $100 million of debt, I'll buy it at 90 million. And if I'm going to have a few defaults, but at the end of the day, I'm still going to have a very good rate of return. That's what Affirm does. PayPal has an arm that does this. They have a buy now, pay later business, and they had shaky, or I should not shaky. Their financials got a little out of whack because they had to start showing some of this debt that they were waiting on customers until they found a partner that they could sell the debt to. That was like 2 or 3 quarters ago. All right. So Affirm to me is beginning to become a lot riskier because the consumer is beginning to really feel the weight of their debt. Both credit card debt, cars are really expensive. They got high car payments. The firm's been really rallying as of late. Last month, they're up 48%. Holy smokes. Year to date. So it looks like the stock had been sold off really nice consistently, and then it just took off like a rocket ship. Probably because their financials showed that they were doing well. Now, Affirm is, I showed you my portfolio of financials. I'm good. I don't think I need one more financial, company. And these guys would be like in consumer finance industry within financials, but they're growing real nice. My biggest concern with Affirm is that they're kind of a one-trick pony. And if they get the way their lending practices are wrong, these guys can lose a lot of money fast. So that is one of the risks. Right now, analysts are saying that it's overpriced. It's priced too high. Their growth is really impressive. The founder of Affirm is an impressive guy. He was, I think, co-founder of PayPal. Max, I forgot his last name. And so the growth is really impressive, awesome, but they're losing money. And I don't know if they generate cash flow. They do generate free cash flow. And they just started generating cash flow. Very good. They're growing so fast that, yeah, they're worth 5 billion. They might be worth 10 billion, but 15 billion is pretty pricey. And I feel it's a little risky. I'd rather go to a PayPal because PayPal has greater diversification across different classes of finance. They have buy now, pay later, but they also have the Venmo business. They have the PayPal business. They have a lot of businesses that really can help them sustain their revenues. And if they have one business go bad, it doesn't tank the whole company. They're growing nicely, not as fast as Affirm, but they're much larger than Affirm. Affirm is a $1 billion company. No, 2.3, excuse me. $2.3 billion company, where PayPal is a $31 billion company. So they're, I guess, 10, call it 14 times bigger. They're growing at 8.66%, which is good for a company this size. And they have some really, I think, some really good businesses. Venmo, I mean, who doesn't have Venmo? PayPal, recognized around the world. Very good service. And so they have payment systems, and they have the buy now, pay later business as well. These guys generate very consistent cash flow. It's one of my holdings. It's one of my bigger holdings within financial services. So Affirm is very interesting. It's really impressive how fast they're growing. So if you're into growth, I could totally understand this being a company that you're interested in. It's not, I prefer PayPal, and I just shared the reasons for it. So good luck with Affirm. Let's see how they do. All right, let's get into Tesla. And Brad, I just have to warn you that I'm not going to be warm and fuzzy around Tesla. I apologize in advance, sir. So market cap, $754 billion. That's the most expensive car company in the history of mankind. Now, having said that, let's see here. Their revenue is 95 billion. PE is really high. Forward PE is 84. Okay. If we look at their revenue, they've hit a growth wall, and they hit the wall in Q1 where revenue went down 8%. And then year over year, I think the most latest quarter, they did grow a tiny bit, 2.3%. But when you look at a valuation like theirs, it's like, really, this stock's that pricey and they're not growing. And there's a lot of Tesla defenders. And FYI, I'm a Tesla fan. I think it's cool what they did. I think it's super cool. But it's a car company, and car companies are car companies. And if you compare these guys to the more traditional car companies, their valuations through the roof. All right, so they're not growing, and I think their cash flow is really low. They went from being a decent cash flow generator, and their growth of cash flow was looking good, but again, they hit a wall. So back here, their cash flow is looking pretty good in 22, but then it dropped. And then it dropped severely. And this is one of the most important valuations for me and most long-term investors is cash flow. So where's the cash going? Well, prices have been going down on cars. No big secret. They've reduced their prices on a number of occasions. Cost is going up, labor cost, material cost. So they're being squeezed. The sale price of their cars is going down. The cost of their products going up. They're being faced. I think their most consequential risk is China. Chinese EVs are coming on strong. And we may not see it here in the United States where we're going to be protecting the auto industry. But Chinese EVs are already showing up in Mexico, Latin America. I'm sure they're all over Africa. I'm not in Africa. I'm just guessing. You're seeing them where regions where they're building out their middle class and people are beginning to have enough disposable income to buy a car. They're not going to buy a Tesla. They're going to buy Chinese EV because it's a third, if not a fourth of the cost of a mainstream EV from Tesla or GM or Ford. So that's the biggest risk factor to Tesla. Now, a lot of people might say, well, Tesla's in a variety of businesses. Tesla says that they're an AI business. Tesla says they're a solar business. All right, well, can Tesla make up their minds on who they are and tell us? If you're not a car company, then why the hell do you sell so many cars? Can somebody answer that question? If you're not a car company, why do you sell so many cars? Because your revenue is representative by like 99% car sales. So that's my story on Tesla. When we look at their valuation, it does not look good. Tesla is led by a rock star CEO. He is a rock. He hosted Saturday Night Live. He's a rock star. But I believe his company is overpriced by 74%. It's not even close if we look at the numbers. Now, Tesla, Elon Musk can come out and say something really, really interesting. Like, oh, man, we're going to do something that's super, out of this world. And people buy it up. I think, latest announcements were robotaxi. And I've got a comment on robotaxi. The robotaxi leader right now, in my opinion, in the US is Waymo. Waymo's already been driving self-driving cars in major cities in the US. They've been working at it for over 10 years. It's taken a long time to get certified and licensed and approved by governments. Tesla believes that they could just jump in and say, hey, man, we're Tesla. City of Los Angeles, or state of California, let us drive around. We don't have any data to show you that our cars are safe, but we got a lot of data of the average person driving their car. It's like, well, is that the same thing? I don't know. Somebody else will have to make that decision. I'm just pointing out that they came out with the robotaxi story and the stock flourished. It's like, okay, but is that going to happen next quarter or in 10 years? Somewhere in between, I'm sure. But it's not going to be quick. Waymo is run by Google Alphabet. They got more money than just about anybody else. And they've been carefully growing that business. Waymo's formed partnerships with Uber. They have their own ride-hailing app, but I think what they want to do, what Alphabet wants to do is, partner with others who can execute the actual driving of cars, can participate in the investment of capital. Then Waymo sits back and gets value from their intellectual property. I love that. That's where you want to be. You want to be in a business of, you create the intellectual property once and you sell it to 1 million people. And then your average per sale cost is super low. Your profits is super high. Your IP is the best in the market. So people want to use it and you're off to the races. That's a consistent recipe for success at Alphabet. So Tesla's got some pretty big competitors out there. Chinese EVs on the self-driving robo-taxi business. They got to lock horns with Google Alphabet. And I don't care what Tesla says about them seeing, oh, we're going to be better than them. Really, well, they've been operating cars, self-driving mode for 10 years. What have you been doing? Oh, we've been having people drive our own cars for 10 years. Well, that's not the same thing. So I'm obviously think that the stock price is way too high, but I will end by saying I still think Tesla is a great company. The company is not the stock price is not the company. I think it's very commendable to see what they pulled off. One thing that people forget about Tesla, when they started, and I still remember when they started, the US government was in essence helping companies get started that had a renewable energy component to them. And they got some of their initial funding from the US government, and they paid it back like champs. Other companies participated in it. Forget the other company, something Fisker, Price Fisker or something. But that's that's a good situation when the US government can get their act together and help entrepreneurs. This is a very good case study that I hope they can replicate. I think it was good like COVID, right? Where we needed to find a vaccine to, keep people from dying. That's another good example of, hey, US government, if you can get your act together and help industries, I think it'd be a good idea because China certainly does that. Now, I think the US, capitalistic society, I mean, it's super powerful. That I'd rather have this, every single day of the week. But it's a really cool case study to see that I think it was 15 or 20 years ago when the US government did provide some of the funding to Tesla. And then Tesla paid it back, which is good. And then the rest is history. So good stuff there. One guy's comments, one investor's comments. And that's Tesla. SLB. Let me catch up on comments because we got a lot of them. So we talked about Baba, Soren Ivan. So you bought some Vici yesterday. So, we've been talking in the other comment you have there is, do you think it's a good time to buy oil companies? So we've been talking about oil companies for a couple of weeks, and oil prices creeped up on us. They went from like low 60s to low 70s, and that was a pretty good move. And oil company stocks went up during that time. So it's always a good time to look at oil companies because it's a good diversification play. And, I would say that, do your homework and they make a good investment, but I think low 70s oil is a pretty decent place or position of that commodity to look at an oil company. And good luck with your Vici shares, man. Thanks for joining. All right. So REITs just dropped across the board. Wonder why. Yeah, why is that? So interest rates dropped. That is going to help a REIT. I don't know. I would have guessed that REITs would have gone up in value. That's nuts. All right. So I'll have to figure that one out, or at least try to make sense of it. Tomas, what is your area of expertise? Yeah. So I think you're asking industry wise. So I'm going to talk about industries. So I've spent a lot of my professional career in technology, software, and enterprise solutions in that space. So I consider that to be an area of knowledge. I worked in an oil company, so I have knowledge there. In my professional life, I consulted to companies that operate, a lot of them being in supply chain related industries. So if you deal with like an Amazon type company, I have expertise there. And then pharma, I worked at a pharmaceutical company for a number of years. Now, my career, the occupation I had coming out of college, I was educated in accounting, got an MBA. So my first part of my career was in accounting. So I did accounting for an oil company. I did accounting for a pharmaceutical company. And then I got a job consulting, helping implement accounting systems as well as supply chain systems and really back office systems for companies that spanned supply chain, spanned semiconductor. I went into a variety of industries and got to know them because I would help them implement systems that would help them operate their companies. So that's kind of like the realm of my knowledge base. So to answer your question. So, all right. So Trader Prad, Apple is so strong today. All right. Well, goes to show. Let's see where I'm at with, I think I'm going to show you the ugly side of my portfolio. So before I do that, let me get emotionally ready to take one on the chin around Apple and look at my portfolio, see how high it is. Come on, portfolio. Okay, so we are up. All right. Okay, I'm good. I'm emotionally ready. I'm up $29,000 on my portfolio. Now let me look to see how much money I've lost on my Apple short. So Apple. So it's up quite a bit, I believe. So I am down 5% on Apple. Or wait, what's going on with Apple? Yeah, it's up 3.5%. I'm down like 5% on my Apple short. I still believe the same story. The stock could be up 3.5%. That's fine. Stock price is not the company. Company's not the stock price. The company is not growing. They're in an industry where you're as good as your products. And if your product isn't growing, that means somebody else is growing. And they're growing because customers like that product. And it's going to play out over a couple of years. And for all I know, Apple figures it out and starts growing again. And if that's the case, I get out of that short position. Or if I lose more than 30%, I get out of that short position. I don't want to lose so much where I'm like an idiot losing too much money. And if I make some money, I'm going to get out of the short position. But I believe the story on Apple is that it's a stock that's priced as a growth stock, but they're not growing. And their product is not that impressive anymore. It's just blah. It's like Sony. Sony's an awesome company. But there came a time when they stopped being super cool. They went from being super cool to just all right. And now, do you ever think about Sony? It's like they're a quality company, great company, but they just were not a leader. Like, geez, a long time ago, like 40, 50 years ago, 40 years ago, I guess, the Sony Walkman with the little foam, headsets, and you have a Walkman with the tape cassettes. I mean, that was like your head would explode. It was so cool. But now, when did Sony ever come out with a product where everybody's like, wow, man, that's freaking phenomenal? And I think Apple is going down that road. They don't have their founder anymore, the late Steve Jobs. Wozniak is kind of a head case. I think he was a genius for being a co-founder of Apple with Steve Jobs, but they don't have that entrepreneurial kind of mindset. And Steve Jobs was such a hard charger. That dude was he would just charge up a hill and kind of carry the company on his back at times. They don't have that anymore. They have Tim Cook, which he's great. He's a nice guy, but he's not a guy that is like, wow, he's just going to be an evangelist. He's going to carry the company on his back. He's just been operating a business. The failure to do the Apple car. I mean, why were they even starting to develop a car? That was kind of a nutty idea to begin with. They're way behind on the AI front, where Google Alphabet's way ahead. Google Alphabet develops the Android operating system that competes against the iOS. Android is licensed to other device manufacturers like Samsung or Huawei. And Samsung is the leader globally in smartphone sales now. So I think Apple has a lot to deal with, and I will continue to hold this stock short. Probably going to add, I might even short shares today on Apple. We'll see. I don't trade in the first hour, but we're getting around to the first hour getting behind me. So there we have it, folks. I lost some money on this short, but I made a lot of money on my portfolio. I'll take it. All right, we got to keep moving. I think I got a lot of symbols to cover, so I'm going to start moving a little quickly. All right, so let's talk about SLB, and then we'll talk about Ford. What is SLB? Oh, Schlumberger. We've talked about Schlumberger. This is the third time in a week and a half. And I love saying the word Schlumberger, by the way. I actually did business in Houston with, that's where the oil industry is headquartered for the U.S. And I had colleagues that worked on Schlumberger and in their back office systems and so forth. And really interesting company. It's a pretty, they do services for the oil complex, $60 billion market cap. And when I look at Schlumberger, it doesn't value as well as I would like. Analysts say that it's discounted, but that's based on earnings per share. If you look at their free cash flow, I believe from memory, their free cash flows didn't do it for me. So I liked Pump instead of Schlumberger. We'll get to Pump next. So $4 billion trailing 12-month free cash flow. And that's a good cash flow, right? In the past, it's been lower. So that's kind of a high point. At best, I could value this company around $40 billion in market cap because they're not a high growth company. And they're at 60 billion. Now, when we look at their revenue, they're doing 12% growth, but you could see that this industry could be cyclical. Are we having a couple boom years followed by some red years in the future? I don't know. So when I look at Schlumberger, it's like, okay, it could be an okay investment. Their dividend is decent, 2.5. It could be an okay investment. It's been going up over time. But when I look at Pump, it just has a better valuation. And Pump really focuses, they're smaller and they're more focused. They're less than $1 billion market cap. They're focused on doing fracking, which is a very popular oil extraction process in the United States. And they present just a better profile for me. When we look at their free cash flow, again, they're less than $1 billion in revenue, and they're $148 million in free cash flow. When I value this company, it's like 50% discounted because when I take that into account, the company just has a better valuation for me. Neither one is a great place. It's not like I would buy either one and wait 5 years and expect it to double in value. I wouldn't expect that from either one. It's not the type of stock that would do that. See, over 5 years, it's gone up 23%. So both are oil services companies. They're interesting, but we get to choose from thousands of stocks. We don't have to buy oil services companies. Owning an oil company is a different game because oil companies, they own the right to extract oil out of a particular, area. Like Chevron has reserves in Alaska, the Kenai Peninsula, very, very, very profitable for them. And they have the rights to extract the oil. Nobody else does. And that type of barrier against competitors enables Chevron to be more profitable than other types of companies. That's why I like oil companies. And I like companies that have a way to keep competitors out. Schlumberger has to compete against Pump and a variety of different companies. I'm sure other countries are also beginning to compete with them. The U.S. is very good at extracting oil. It's an industry that we've been doing for a long time. But in that long time, other competitors have come into the market. So those are my comments on Schlumberger. And it's interesting that a couple of things is the community in this live stream, we've talked about oil companies for a couple of weeks. I think that's a very good sign that investors that tune into this are thinking along the right lines, which is, hey, you know what? Oil companies are getting discounted and oil prices are down. But hey, man, can we take advantage of it? The market's discounting them, and we know oil is going to go up eventually. So very good thought pattern over the last couple of weeks. And if you look at oil prices, let's say my holding is Chevron. If we look at the last 30 days, we've seen a rise in oil prices the last couple of weeks. So we were talking about oil companies in this range where, hey, the market's really discounting oil companies. It's a good place to look for value. And the answer is yes. So I'm glad the community is kind of talking about something that can yield some good value and profits for investors. I'm glad we were talking about that. So good stuff. Let's talk about Ford. Ford is a well-operated company. They've been around for more than 100 years. Now, my biggest problem with Ford, I could show you that they're highly discounted, but the stock market just doesn't like the legacy auto companies. GM was really the pick for last year. GM has really done well. I preferred Ford over GM, and that was my bad luck or my bad decision. You look at GM over the last year, good job, GM. GM's doing really well. They're operating well. Free cash flows are great. Massive company, 178 billion. And their PE is super low. Even after going up 45%, their PE is still at 5. Incredible. They're still discounted a bit. But legacy car companies, what's their market cap? 55 billion. What was Ford's? 44 billion. That's a pretty good market cap, but both these companies have been around for more than 100 years. Do I expect these guys are going to double in value in the next 5 years? No, neither one. So I'm careful not. I got out of Ford, and I probably made a little bit of money, but nowhere near my time value or my opportunity cost. And I'm probably not going to get into the car business anymore. I think it's just getting me way too competitive. Again, China EVs are just going to come in and disrupt a lot of companies. And if you think about how China has taken on the computer industry as an example, when I bought my first computer, it was, long time ago, like 30 years ago. Everything was assembled here in the US. Some components were made in China, but even some components were sourced from a US supplier. Intel chips is an example. Well, now the whole computer industry and TV business is offshore in China, and China's done a great job. It's not like they've done a terrible job. They've done a great job. Cars are going to follow that pattern. As we see products exist for a long time, they get mature and the consumer wins. They get a better product at a lower price. And cars are going to follow that pattern. Consumers are going to get a lower price and a better product. And the companies that operate like Tesla, GM, Ford, they don't like that. They're like, no, we want prices to go up. We want profits to go up. And it's like, no, market forces, baby. Over time, prices will go down and value will go up to the consumer. That's just the way it is. And when you've been around for more than 100 years as an industry, that's what I expect is going to happen. So I'm out of Ford, probably going to stay out of Ford, lick my wounds, and move on to other companies. Speaking of wounds that I need to lick and acknowledge that this just didn't work is Alibaba. Alibaba is up 4% today, but this has just been like a stock that has so much value. It's a big cap, but if you look at their value, and I think this US dollars, yep. When we look at their cash flow, these guys are like Amazon. It's almost like Amazon replica that operates in China, and it's accessible to US people, by the way. You can buy stuff on Alibaba, which is a really neat idea where they're actually matching companies here in the US that want to buy from a Chinese company. That's a very good connection that has a lot of potential, and it's already, going quite well for them. But when we look at what am I looking at? Cash flows. So free cash flow, 126 billion. And I think this is in the Chinese currency. Yeah. So this is the Chinese currency. So let me just jump to my model because BABA is the stock that I own. And I made all the currency translations on this model. So it's discounted by 36%. Their earnings per share look, off the charts. Their cash really supports the stock price. So BABA is discounted, but the market just doesn't rally around this stock. It's had a unimpressive existence. We look at the 1 year, it's up 0.62%. It's had moments where it just really took off. For example, back in the late spring, it had a nice rally, 28%. It is on an upward trajectory if we look at from June to now. But it seems that, a couple bad comments from politicians that we're going to start having more tension with China, and this stock goes down. So this is a stock that's really interesting, but I'm beginning to get fatigued on waiting around for it. I own Amazon. I'm building that position as fast as I can. And I might switch horses and go from Alibaba to Mercado Libre. Mercado Libre has got a lot of positive energy. But that's Alibaba. It's a company that has fundamentals that look great, but the stock just doesn't move, which is interesting. And I think PD is going to be kind of in a similar boat. PD is also an e-commerce company in PD. How come I'm not seeing PD? I think PD is that. Are we talking about PagerDuty? Did I write that right? Yeah, PD. So Pratt, is this the one you wanted to look at? PagerDuty, 1.7 billion in market cap. PD, I thought it was Pinduoduo. But if it's Pinduoduo, it's in the same boat as BABA. It's interesting business. Valuation looks good, but the investors just don't really like it because it's a foreign company. There's tension between China and the US. Every time there's a war of words, the Chinese stocks sell off. It's just the way it is, unfortunately. All right, so catching up on comments, and I'm going to begin to land the plane, get to my day. So I'm going to kind of scan the comments, and I apologize if I can't get to all your comments, but we are on fire today. We are, guys, thanks for showing up, and I apologize that I'm running out of time, but as I hope you can appreciate, I need to get going on my day. So let me just kind of highlight some of these comments and maybe cover some of these stocks in tomorrow's stream, which I will be streaming 6 a.m. Pacific tomorrow. I'm going to start noting the symbols that I'm going to cover tomorrow in a new sheet of paper. I'm still a paper guy, by the way. I love computers, love them, but still write notes on paper. All right, so we talked about Apple. So Nichix TMUS. I'll take a look at it tomorrow. And I apologize, couldn't cover it on this stream today. And yeah, the dividends on some of these stocks we were looking at were freaking phenomenal. Pretty awesome. So Mike, Airbnb, it's over $8 today. Oh man, I love Airbnb. And I'll cover it tomorrow. All right, so Trader Prad, price too high. Yep. Rio Tinto. You know, let's cover it tomorrow. The one thing I would say about materials companies, it's not a bad time to be thinking about them, right? We were thinking about oil 2 weeks ago. It was a good thought. Well, if the economy isn't going to hit a wall, it's going to have a soft landing. Material companies are going to start going up. So Rio Tinto, TX, there's a number, BHP, which is primarily in Australia. Let's talk about those tomorrow. I think it's a good thought. Keep thinking materials, because right now materials companies may be in the buy zone. Hey, nobody's thinking materials. Nobody's thinking about Rio Tinto, and steel prices are down, but you get some demand going and that steel price goes up and stock price go up, and they pay a nice dividend in between now and then. So I like where your head's at. Let's talk about Rio. Best of, good to see you. Prad, thanks for bringing a lot of energy this morning, sir. And I will see you tonight. We'll mix it up and talk about some trades tonight. Get ready for tomorrow. Today is going to be a lot to digest. The NASDAQ is up 2.75. Beautiful. Let me take that in. Let me soak that in for a moment. And then S&P 500 up 1.79. Dow Jones 1.26. The Russell 1.76. Nice. I will take it. Let's see if the market can lock in those gains. I hope it doesn't fade. Yesterday it did fade. You know, the NASDAQ was up almost 1%, and then it ended in the red. Don't want to jinx it. I'm just saying, if it does that today, it's going to spook me. Halloween is not until next month. And if the NASDAQ spooks me, man, I'm going to be a scaredy cat to some extent. All right, everybody. Thanks for tuning in. We will take a look at stocks again tomorrow at 6 a.m. Do me a big favor and consider becoming a paid member. It's $10. And I will share some of the tools that I use with members only going forward. And it'll just support the community overall, the cost of operating this community. You can go to it on YouTube and become a member. And I'm going to be moving up the rates eventually. And everybody who locks in a member and becomes a $10 member, you'll always be at the highest level of membership, even though I plan to have memberships at $25, $50, and $100 eventually, not right away. When am I going to make those decisions? It could be as early as the beginning of October 1, or it could be November 1. That's coming. I wanted to let you know. Consider being a paid member. I'd hate for you to tell me, hey, why didn't you tell me before you made these price changes? I would have become a paid member. Here's your chance. Become a paid member, stay a paid member, and you'll have access to a lot of the tools that I've been sharing with you guys. I really love what I do. But at a certain point, I got to start recovering my costs. I hope you understand. And with that, everybody, have a great Thursday. Enjoy the gains. Soak them in. Have a great day.